Now then, let's take a look at what's going on here in Asia. Decoupling is back, says HSBC. Economist Fred Neumann says the Asian bounce back from the global recession has been far stronger than in Western markets, to the extent that asset bubbles may be appearing. And Fred's with me now in the studio. Very good day. Thanks for joining us. Decoupling. I mean, it was in vogue, and then it was a dirty word because all markets were falling together. Now you're saying, based on the evidence, I guess, really, that it's back.
Yes, if you look at economic growth, for example, it's bounced back much stronger in Asia than anywhere else in the world. And it's not just fiscal pump priming, it's even real domestic consumer spending, which has soared in the second quarter and is now even positive in year-over-year terms across Asia.
And so, I mean, people were calling that for a long time, and basically you needed to move away from the exports and get on to consumer demand. So what you're saying here is the exports, they went away by default because the global markets collapsed. But the consumer demand was already growing. Has that consumer demand actually accelerated lately?
It has bounced back. And what we had in Asia were two recessions which happened concurrently. One was the export recession, and the other one was the domestic demand recession due to high inflation last year. And that second recession of the slower domestic demand, that is being unwound now, and that's coming back, and that's helping to drive decoupling across Asia.
And it's not just pump priming, but a lot of it has to be the liquidity. Yeah?
Exactly. It's not just fiscal spending, it's also the monetary stimulus that's coming through. Remember, all central banks have cut rates to record lows across Asia, and that massive liquidity is now sitting there in banking systems which are essentially intact and can go out and lend again.
And the lending's been not so much encouraged as ordered in places like China, where you can say to the state-owned banks, right, go out, lend money. We know, or at least we believe we know from the evidence, that some of that lending has been diverted into the stock market. That's not necessarily a good sign.
Not over the long run. In the short run, you need rising asset prices to sustain the boom in consumption. And what's a bit paradoxical about this crisis is that the decline in exports reduces the need for facilities investment. So where else do you then lend into? And the only real avenue for lending becomes asset prices.
Okay. So what's going on here? I mean, we don't want bubbles to develop, generally speaking, because they're painful when they burst. To what extent are we seeing bubbles developing here in Asia, and how big might they become?
Well, there are already signs that asset markets have rallied quite strongly and have probably exceeded the economic reality on the ground in many cases. Remember, Hong Kong, we still are essentially in recession mode, and yet property prices are already past or near the peak of last year. And so there are signs that we have very strong asset rally here, which is not necessarily justified by the economic reality on the ground.
Does it matter too much, particularly when you're talking about property prices, given that most people, when they buy and sell, I mean, most of the market is secondary market. There's not that many first-time buyers coming in. They account for, what, 10% of the market or something. So most people are buying and selling, and their only real outgoings are their mortgages, and mortgages aren't that expensive at the moment because interest rates are so low. So does it matter, or is that an indication that this property bubble could run and run?
I think it could run for quite some time. And what's interesting here is that the low deposit rates as well that savers receive on their deposits in banks encourages to go out and buy assets, such as property. It's not just the low mortgage rates and borrowing, but it's also where do you put your savings in this world? And really, property and stocks are some of the alternatives.
Yeah, nobody wants 0%. So can we, I mean, here in Hong Kong, the benchmark is 1997, really. Do we go past those kind of levels?
Well, we're now, I think, around 65% of those levels. And that was over 10 years ago in nominal terms. So I think it's not inconceivable that some stage of the next 2 or 3 years we could revisit those highs, not just in the property market, but perhaps even in stock markets.
Okay, so that means for the Hang Seng we could be topping 30,000 again.
At some stage, yeah, we're only there not too long ago.
Yeah, exactly. 40, 50? I mean, bubbles, the problem with bubbles is you never know when they're going to end. George Soros said only recently, speaking to CCTV, when he sees a bubble, he buys, because he knows he can ride it for some way.
Well, I wish it was that easy to identify bubbles, because if it was, then we wouldn't have any, because policymakers would stop these bubbles short. And so you need a degree of uncertainty during the bubble for policymakers to remain accommodative and allow it to grow. It can't be that obvious that everybody says this is a bubble and I'm going to buy in.
Right, but although you have made the point in the past that you get little corrections when policymakers make minor moves towards stopping bubbles, and that puts some fear into the market, but then everyone everybody rushes back in again twice as fast.
That makes bubbles sustainable over time. You need a bit of stop and go here. It's not a straight shoot up to 40,000 Hang Seng.
Okay, so the question is, how do central bankers deal with that? We're going to do that after the break when we are joined by Trish Louis as well. We can talk a little bit about the impact central bankers can have on currencies and on bubbles as well. Which all fits very nicely into what we've been talking about. Bank Indonesia has been cutting interest rates all year, may cut again today. Asia is awash with liquidity. Fred Neumann's with me here from HSBC. This is what we've been talking about. Asia's got a lot of liquidity. Interest rates are very low. That is partly, in your view, due to the fact that central bankers are kind of fighting the old model, that is protecting exporters, yes?
Yeah, we have traditionally an outlook among policymakers in Asia that they want to maintain a competitive currency because growth is seen as being entirely dependent on exports. And if you keep the currency competitive or locked against the US dollar, you need to keep interest rates low to prevent appreciation. And that's fueling, really, the liquidity boom in Asia and the loose monetary conditions.
Trish.
Fred, which of the Asian central banks do you think are going to be the first to pull the plug as far as soaking up liquidity is concerned, or even exiting the current easing policy bias? Do you think any of them at the moment is on a neutral bias or inclined to adopt that at the moment?
Well, generally, there are two central banks that come into mind. That's the Bank of Korea and the PBOC in China. Of the two, we think the Bank of Korea is perhaps the more hawkish one. And in fact, in the past, we've seen the BOK even hike if inflation wasn't a threat because they were concerned over asset prices. So if you look for a signal, I think Korea would be the first one to do that. But even there, only a gradual rate increase, maybe 25 basis points per quarter, nothing dramatic even there.
And, Fred, on the flip side, which countries in the region would you say are least able to raise interest rates and therefore risk having bigger bubbles?
I think Thailand, for example, is one of these countries. And the reason here is that you have still domestic political uncertainty, and that's weighing on the domestic asset bubble. In fact, Thailand is not as big a risk at this process because of domestic problems. Elsewhere in Asia, perhaps the Philippines might be a bit slower because there the growth shock hit a bit later, so we might get out of the cycle a little bit later. But by and large, I think we see fairly stable rates for the coming 12 to 18 months across Asia.
And the standout case has to be here in Hong Kong, where we actually have a fixed peg to the US dollar. And not only is there an economic argument behind that, but there's a big political investment in keeping that peg, perhaps past its actual sell-by date. Do you see as getting a big bubble here in Hong Kong and eventually a peg breaking?
I don't think the peg is going to break anytime soon. Hong Kong policymakers have a strong commitment to the dollar peg, and I think in the past they have shown a great tolerance when it comes to asset bubbles and deflation and so forth. They allow the economy to take the pain or the gain, whatever it may be. Maybe some distance in the future, very distant, we're going to look at pegging to the renminbi, but I think that's a long way off still.
Trish.
Fred, do you think that apart from BOK, like you mentioned, which may be the first to raise interest rates, what about PBOC? And do you think that they're going to be going the route of hiking banks' reserve requirement first, and soaking up the cash liquidity rather than tweaking interest rates?
Well, I think the PBOC is talked about as being a slightly more hawkish, but our general view is that, yes, they might tinker at the margin, but we're not going to see aggressive tightening in China anytime soon. In fact, there's reason to believe that loan growth is going to cool off over the coming 6 months or so due to seasonal factors alone. What the PBOC might do, that the authorities might do, is maybe tighten the capital adequacy ratios there and to make sure that banks have sufficient provisions for possible NPLs. I think that's more likely to cool down the lending boom in China.
I mean, you've mentioned in the past, Fred, that directed lending doesn't necessarily work. You can't order banks not to lend or people not to borrow because people always find a way around those.
Yeah, that's a tricky thing. I mean, in any regulated system, investors are very savvy and find quickly ways around that. So the most potent way always is to raise interest rates across the board. But it's very difficult if you keep an eye on the exchange rate, and that's Asia's dilemma.
Okay. All right, Fred. Thank you very much indeed for that. Fred Neumann, economist at HSBC.